Failproof way to become financially free with passive income. In finance, passive income refers to money derived from a one-time investment that creates ongoing income flows without needing the investor to actively monitor or alter their assets. Passive income, like active income from employment, is taxable, although the IRS typically treats it differently. Passive losses, for instance, can be used to balance passive benefits. Aside from the difference in tax categorization, many people want passive income to enhance their cash flow, and the word has expanded to encompass activities such as working from home or side gigs that require little effort, even though they may be taxed as active income. In order to produce passive income, becoming a limited partner in a partnership is one option. However, ordinary individuals can put their money to work in alternative ways. Here are some fail-proof ways to become financially free with passive income. Welcome to another The Trend video. In this video, we are going to talk about the fail-proof way to become financially free with passive income. Before moving further, kindly like this video and subscribe to our channel so that you don't miss our upcoming amazing videos. So, let's get started. 1. Real estate. Despite changes in recent years, real estate remains the preferred asset class for investors seeking long-term gains. In particular, rental properties can provide apartment owners with a consistent stream of income. The investor can simply acquire a home with a 20% down payment, then install dependable renters who maintain a steady cash flow. Real estate investment trusts, REITs, can be utilized by those who do not wish to manage rental properties. 90% of REITs' taxable income is distributed as dividends to investors. Dividends are taxed as ordinary income, which may pose a difficulty for investors in higher income brackets. Real estate crowdfunding offers a compromise answer. Both equity and loan investments in commercial and residential properties are available to investors. In contrast, REITs crowdfunding enables investors to enjoy the tax benefits of direct ownership, including the depreciation deduction, without the additional obligations of property ownership. 2. Peer-to-peer lending. Although the peer-to-peer lending (P2P) industry, also known as crowdfunding, is only a little over a decade old, its growth has been exponential. It is the act of lending money directly to a person or a corporate entity using internet platforms such as Prosper or Lending Club to link lenders and borrowers. Returns typically range from 7 to 12%, and the investor has minimal responsibilities after funding the loan. P2P programs have typically lower entrance barriers than other sorts of investing. For instance, investors can fund loans with as little as $25. Title III of the Jumpstart Our Business Startups Jobs Act permits both accredited and non-accredited investors to invest in crowdsourcing. But each P2P platform has its own participation restrictions. 3. Dividend stocks. Stocks that pay dividends are one of the easiest ways for investors to generate passive income. As public corporations create profits, a portion of those profits is siphoned off and distributed as dividends to shareholders. Investors have the option of retaining the cash or reinvesting it in further shares. Dividend yields can vary substantially from one company to the next and from one year to the next. If investors are uncertain about which dividend-paying companies to purchase, they should stick to dividend aristocrats, which have a track record of at least 25 years of paying out high dividends. 4. Index funds. Index funds are mutual funds or exchange-traded funds that are correlated to a specific market index. These passively managed funds seek to replicate the performance of the underlying index they track. Therefore, their underlying securities remain unchanged unless the index's composition changes. This correlates to lower management expenses and turnover rates for investors, making them more tax efficient than many other assets. Things to consider when choosing a passive income investment. Earnings from a rental property, limited partnership, or other business in which a person is not actively involved are considered passive income. This indicates a set-it-and-forget-it mentality that may occur with these investments. Nevertheless, many passive investments still demand active management or attention. Consider real estate as an example. A rental property must be maintained, and tenant complaints must be addressed and resolved. Frequently, landlords must also maintain insurance coverage and adhere to safety and other regulations. Passive income investments also require some care, since the relative portfolio weights will need to be changed and rebalanced over time as the individual stocks within an index rise and fall. Investors are responsible for determining the frequency and timing of rebalancing. What is the highest paying passive income investment? The optimal passive investment will change over time and from year to year based on a variety of factors. Real estate, whether held directly or indirectly through real estate investment trusts, and dividend-paying equities have historically outperformed other asset groups. Are passive income investments a good idea? Generally speaking, passive income investments allow you to employ money to make money, putting your money to work instead of you. In this regard, they are frequently a smart idea. However, be wary of pitches that sound too good to be true or get-rich-quick advertisements that promise easy money with no effort, including multi-level marketing, MLM, and other work-from-home schemes. Several of these will ultimately cost you money. How do you begin an investment for passive income? If you have money to invest, you can put it to work by purchasing the proper passive asset, such as a REIT or an index ETF. In such circumstances, you may need to open a brokerage account to transact and hold your investments. Passive income investments can significantly simplify the life of an investor. The 4 options presented throughout indicate varying degrees of risk and diversity. As with any investment, it is essential to assess the expected returns of passive income sources against the risk of loss. So this is all for today's video. What are your thoughts on this? Which of these ways do you think can make you financially free? Do you think passive income can help you achieve your financial goals? Let us know in the comment section below. Thanks for watching this video. If you found it informative, do like and subscribe. And don't forget to give comments and provide us with your valuable feedback. Plus, if you want to suggest a topic for the next video, please feel free to tell us. See you in the next video, and until then, stay tuned to The Trend.